Good morning, everybody. This is our macro session where we look back on what happened last week, what's potentially going to happen this week, and just what are some interesting topics, themes that are currently in the market. What's the current narrative? So as usual, we got a bunch of slides to get through. There's been a lot happening over the last couple of weeks, so we'll get into it. Probably don't need to remind any of you, SPY at new all-time highs. We've had this previously quite choppy period through this chart just goes back to the end of September. You can just about see post payrolls. Payrolls came in around about here, around about the 4th of October. Post payrolls, it's almost, let's say we're quite back to that low vol uptrend, but it certainly looks a lot different than the period that we were in pre-payrolls. So last week was the post-payrolls week, and it did seem like Nvidia moving higher again. Nvidia's in the purple line. SPY with some nice low volatility candles moving higher. Meta, even utilities managing to recover off a low base. They took a bit of a hit on payrolls due to interest rate expectations getting priced out. But it certainly seems like the market sentiment, at least within equities, is for the time being turning more positive, more glass half full than half empty, shall we say, and choosing to focus on the positive economic signals rather than being disappointed that interest rate cuts are being priced out. So that's positive for equities over that period. If we move on to the next slide, the other big story, of course, has been China. China reopened at the start. China reopened at the start of last week. It was closed for Golden Week. That's this sort of flat period there. On the chart, we've got the Hang Seng futures on the candles, and the purple is the CSI 300, which is the onshore index. Both been moving up over this period. The big events at the weekend, and obviously there's been a whole bunch of sort of stimulus measures announced by the Chinese over the last few weeks, and we'll take a look at those a little bit later. But the most recent event post the reopening, there's a little bit. This is markets reopening at the start of October, and you can see there that once they reopened, the onshore markets fell. The Hang Seng fell. What's that? About 14% over a matter of a day or two, because there was an expectation that at the end of Golden Week there would be some more announcements around stimulus measures, around central bank policy. There wasn't. Markets got disappointed by that. There was significant selling. I think the hedge funds were long going into this, and at this point very quickly rotated out, some even becoming net short Chinese equities on that move. I think there's been a few news articles floating around from Goldman's, or well, taken from a Goldman's report, their prime book report. So big banks like Goldman's and others offer liquidity for hedge funds. So if you're a hedge fund, you leverage up your trading capital by borrowing money, just like anyone would do with the margin account. To do that, you need what's called a prime broker, and Goldman's are one of the biggest prime brokers out there. Citigroup, others are obviously big as well, but Goldman's are a big one. So when they talk about their prime book, that's the book of business is being transacted by the prime brokerage clients, who are generally hedge fund clients. So they have the ability to see the flows in real time almost. They see what stocks the hedge funds are buying, they see what they're selling, and they aggregate all of that data and they report it. They're not going to tell you what any one individual hedge fund is doing. They can't. They're not allowed to. They might not even know. But their research department will aggregate all of that prime brokerage data and report it with a view to maybe being useful to somebody. So you'll see at different times headlines in the Financial Times or different financial news outlets about prime brokerage, prime flows. That's what it is. It's basically telling us what clients are doing. And what they did last week was sell Chinese equities and buy US equities, and specifically tech stocks. So maybe that's another reason we're seeing Nvidia moving higher. But a shift in flows there out of China by hedge funds into US equities over this period, partly because of disappointment on the reopening, but also at the weekend on Saturday. There was an announcement, there was a press conference, and there was an expectation, we'll cover it later, but there was an expectation that there would have been a number put on the stimulus. They didn't put a number on it, and they somewhat disappointed, I think, the foreign market, the internal market, the internal buyers of Chinese shares seemed happy enough with it. But lack of detail, I think, disappointed some of the more tourist type holders, shall we call them, the people who are just in it for 1 or 2 days, 1 or 2 weeks. They've come out, the short-term holders are out, but there's still plenty of interest in Chinese equities, and Goldman's have upgraded their Chinese GDP expectations, so that's one to keep watching. Government bonds yields continued to move higher last week. I put a blue line in there that's the payrolls cut off. So post payrolls, everything jumped on payrolls, but the 2 years been relatively flat, while the 10-year continues to climb. So yields moving higher. In one sense, that's positive. It shows that there's an expectation that growth is going to continue in the future. On the other hand, it might lead to some problems down the line a little bit later, as we'll see. Currencies in line with rates moving higher. Dollar moves swiftly higher after payrolls, and it's continued to go up, in particular against the yen. Gold's one we've been keeping an eye on over time. We noted when we were back here, it wasn't a particularly good time perhaps to buy in, and we should wait until it comes back to the 20-day. It did come back to the 20-day, had a little rally, and we're just sort of bumbling around here. I've said before, I don't think the macro case for gold going forward is as strong as it was back here, but it's still potentially a good candidate for a credit spread while it remains up here, because gold often has this sort of pattern where it rallies and then it goes sideways for a bit and then it rallies, and remembering that even in sideways price action with the bull put spread, we can still earn premium. So I'm not overly bullish on gold here, but I think we're definitely not in overbought territory like we were. We're still in an uptrend. Moving averages are still all sloping up, and say the RSI has come off overbought territory. So not quite saying green light for credit spreads and gold, because fundamentally I see reasons it could be lower. But if you disagree with me fundamentally, the entry point is certainly a lot better than it was a couple of weeks ago. Oil had a bit of a spike on the China stimulus on geopolitics, but that's now all reversed, maybe somewhat backing up the disappointment in not hearing more coming out of China. Volatility unsurprisingly dropping after a bit of a jump early October. That jump in part is due to the VIX looks out about a month, so it looks at sort of 1 month. It sort of covers that 1 month period, and on the 7th of October was a Monday. The election is on the 5th of November, I believe. I think it's the 5th of November. So just over this weekend, the VIX 1 month window just rolled into the election period. So that's why there was a big spike. It wasn't anything to do with, it was nothing in particular to do with markets. It was just that 1 month ahead look, that the 1 month window going forward just rolled into the election, and that's why you got a big spike in VIX on the Monday. The blue line here is the CVX1 exclamation. That's the front month VIX future. And that also jumped. But this drop is not volatility dropping. It's just that that VIX future moving from October to November. And that's one of the little oddities and issues with using the sort of VX1 exclamation ticker. At some point, I mean, it's nice that it's a consistent series that you can look at, but every so often, as we get within about a week or two of expiry, it's going to move on to the next expiry. And if the term structure is upward sloping, if October is here and December is here, and you move from October to December, you're going to get a jump. But it's not a real move in the VIX. It's just the futures contract changing from one expiry to the other expiry. So that's what that was going on there. But yeah, VIX been trending down as markets normalize, as the standard deviation and the range that we've seen in different stocks and the SPY normalizes. VIX is coming down, consistent with markets being a bit more calm. China stimulus is a big theme. Just a few charts on why and what's happening. You don't want to focus too much on China, but it's such a big part of the economy. I think it's useful to be aware of. This is quite significant. This is just a GDP deflator. It's think of it as inflation to some extent, and that's been contracting for the fifth straight quarter. So for 5 quarters, China's almost been, in a sense, in deflation. That doesn't happen very often in China, as you can see from this chart. Last time it was this bad was actually the 90s, the late 90s, 1999. Happened for a couple of quarters in the financial crisis until they did massive stimulus, which is what that was. And back in 2015, COVID, just pre-COVID. So in 2015, they did a whole bunch of stimulus, and we got a similar sort of stock market rally and bust. Obviously, COVID was stimulus. So this kind of long periods of quarter-on-quarter declines typically is preceded by stimulus. I suppose the surprise here is they let it go on for just as long as they did. Normally, you look back over these periods, they've loaded up stimulus much faster. But that's why the Chinese are acting, because of that, and that's why markets reacted to it, because there was an expectation. People will have been looking at these sort of these quarter-on-quarter falls and thinking, okay, they've got to act now because it's been 3 negative quarters in a row, 4 negative quarters in a row. They have to act now. I think there was a bit of frustration that they hadn't done anything. There were people who were, in Chinese equities, out of Chinese equities, and then finally they announced something, and that's why there was such a big initial reaction to it, because people were waiting for it. They've done a whole bunch of things. They've cut interest rates. That's what's going on here. They've cut the rates on loans for banks. So they've reduced the rate loans in banks because consumer confidence is completely on the lows. You actually see this pattern across, not quite as stark. We'll look at a consumer confidence measure a little bit later for the US. And interestingly, through COVID, consumer confidence was okay. It dropped off a cliff post-COVID. Maybe because everyone had to go back to work. But that's related to inflation going up as well. But yeah, things are not good for the Chinese consumer. They're not good for Chinese banks because their bad loans are going up and their margins are going down, all related to the property markets. I don't have a slide here, but I saw a slide somewhere that shows that as a share of the country's wealth, or as an absolute store of wealth, the Chinese property market is the biggest in the world. So it's one of the largest out there, and it's very important for the Chinese. And that's why they've announced a lot of things. These are all the different stimulus measures that either have been announced or are still to come. So it's really broad-based. It's monetary, interest rate cuts. There's a whole bunch of stuff on property, as well as this stuff that just came out at the weekend. There's a whole bunch of stuff on stocks, and so they really are either have thrown the kitchen sink at it, or they've got a few kitchen sinks in reserve still to come. So still a lot of potential stimulus from China. This is what they announced on Saturday. No numbers, but they did say they have lots of room to raise the deficit. They are basically going to create a new type of debt instrument to allow local governments to refinance to offset property losses. That's one of these sort of help governments finance hidden debt. So yeah, still a lot to come in China, but things are still not looking great for them. Their export growth is flattened. Yeah, they're exporting a lot of steel, but at lower prices. So no doubt the news around Chinese stimulus is not going away. It's going to continue. Chinese equities may well continue up on the back of that or continue to be volatile. Moving to US stocks, obviously a lot of talk earlier in the year, I think, about leadership and how it was all about the Mag 7, but I thought this chart was interesting. If you strip out the Mag 7, or if you equal weight the S&P, because remember the S&P is a market cap weighted index, so things like Nvidia matter a lot more to the price than smaller stocks like Palantir. If you equal weighted it, or if you just strip out the Mag 7, well, we're still doing pretty well. It's still going up. It's still at an all-time high, even without those stocks. So there is something more broad-based happening within US equities. It's not just all about the Mag 7, at least at the moment. So stocks are doing well, but as I said, US consumer confidence doesn't look all that different from China. It was pretty okay through COVID, and then has dropped off a cliff as inflation went up. Inflation is inverted on this chart, so the blue line is inflation, and it's flipped around. So this is inflation going higher. So yeah, we see consumer confidence drop as inflation's gone up, and even though inflation has rebounded, consumer confidence really hasn't all that much. So the market may be doing well in the US, but the consumer isn't feeling as happy as they were post 2017 into 2021, and a large element of that is probably the rise in interest rates. That's the one thing we're not seeing on this chart. I won't digress into causality and mediators, but often when you see a chart like this, where people say, well, that's gone down, well, that's gone up, and that's gone down, and then that's come back up, but this hasn't, you're missing the third element, the third variable. It wasn't so much that inflation going up has hit the consumer, although there'll be an element of that, but because inflation went up, interest rates went up. Now inflation has come back, but interest rates are still high. So the third element probably explains why the consumers are still not feeling that much better off, because rates are still high and liquidity is still tight. So that's the US consumer outlook. This was the payroll stuff we talked about. That's the difference between the number and expectations. It was a pretty big miss, but not. We have seen surprises in the past of this order, but just I guess the timing of it was important. It led to this sort of thing happening, which was the whole kind of interest rate futures curve. It wasn't just that the 2-year went up or the 10-year went up, kind of everything went up and repriced, as we discussed. And moving forward, that led to this sort of thing happening where prior to payrolls, we had some probability of 50 bips. That's gone now. It's completely gone. And we've actually picked up a probability of no cuts, and we're very much focused, almost 90% probability of 25 in November. and it looks similar for December. So interest rate cuts been priced out, as discussed. Of course, that could all change. It's just showing you that rates moving higher. Inflation, 5-year inflation forecast going back up again. You can think of that. So yeah, they came down a lot earlier in the year, but they're ticking higher again alongside yields. This I won't dwell too much on this, but I thought there was something interesting in the Fed minutes where they talked about it being difficult to understand the labor market, and with increased migration, revisions to data, and possibly changes in the underlying growth rate. And that's kind of about, we had big revisions to the data a few months ago that saw sort of all this past payroll data revised, and there's a lot of volatility around it. And part of the explanation for that is net migration was a lot higher than expected, and that leads to more people coming into the job market, unemployment dropping off, inflation. It's people coming into the job market. It's not inflationary. And just see there's been a lot of. Put yourself on mute, please, if you don't want to speak. You don't want to hear everyone. So yeah, this is just one of the things the Fed. It's an example of the Fed. It's not so post into the September rate cuts. It seemed relatively straightforward. The labor market was weakening. They cut rates that would improve the labor market. But then we got the payrolls data that showed a lot stronger than expected labor market post that. And the message coming from the Fed now is actually, yes, we've got all of this data, we've got all of the standard data, but we also, it's important to use context as a check on reading on labor market conditions. So they're kind of telling you that the data might be a little bit misleading at the moment, and maybe that's because of changes in net migration, and of course that's going to continue, and may well be a policy change on migration if Trump gets into power. This was another interesting chart. Not that everybody buys stocks for dividends anymore or yield, but the general the average S&P earnings yield is now the same as the 10-year Treasury yield. So from a yield point of view, you get paid the same amount holding a 10-year Treasury bond as you do owning the S&P 500. Obviously, owning the S&P 500 is a whole lot more risky than owning Treasuries. Now, this doesn't encompass the fact that you could potentially get paid for that risk through growth, but it is quite interesting that this is the first time the two have overlapped since post the dot-com bust in the early 2000s. So for a very long time into GFC and post GFC, stocks have yielded more than bonds with zero interest rates, and obviously the low was of the pandemic when interest rates came down to zero. But now they're somewhat equal. So from a valuations perspective, for very long-term holders that are more interested in yield, it's not clear that stocks are the place to be anymore. So are we at a tipping point in stocks? I don't think so, but that's just one, less. You see a lot of positive charts around about stocks at the moment. I guess that's just one that maybe might explain that long-term holders, the big pension funds are probably not going to be allocating a lot more to stocks, because a lot of them will work off valuation models that look a bit like this. And at the moment, they, particularly with bond yields having risen more recently, that's a bit of a headwind perhaps for stock markets going forward. On the flip side of that, the odds of a Republican sweep jumped, now up to almost 40%. The Senate, the House, the Republicans were always odds on to win the Senate, with the Democrats still greater than 50% chance of winning the House, but that's dropped quite a bit. So part of this Part of this jump in clean sweep odds has been down to the move in the odds of them controlling the House, and that's consistent with Trump moving into about a 10-point lead over Harris. I think that chart shows. So October is often, the October before the November election is often a time for surprises. So maybe we'll get another one before the elections. Who knows? And this could all change. But things have been pretty dull for a while in the prediction markets around the election, and things are just starting to move. And just a few more news stories about a potential Trump landslide. So we'll wait and see. Things could all change from here. As he, it wasn't. If we think back to Trump's first win, I think at this point Hillary was odds on, and of course we all know how that finished. So still plenty of time to go, but we'll probably focus more on these poly-market election odds over the next few weeks as we run into the election. This was an interesting one. Consumer sentiment is lower. We saw that, but particularly for Republicans. So if you split consumer sentiment by party affiliation, you see there is a clear partisan split, with the Democrats getting sentiment going up, plus Biden getting in, and the Republican sentiment down and staying low. So maybe another another indicator towards there's a lot of disgruntled voters out there that maybe hope things will change. But just interesting to see that actually, while broad-based sentiment indicators show broadly consumer sentiment is lower in the US, it's actually pretty much the same for Democrat voters as it was back in 2017. The real changes for Republicans, and to a lesser extent independents. Thought that was an interesting chart. Moving forwards, this is what's coming up this week. Not so much on the macro data front, but just other things. We've got earnings. See, in earnings season, we've got Goldman's, all of the financials coming through. Trump interview, that'll be interesting. Some Fed speakers, ECB is a non-event. Retail sales, that's the main bit of macro data for the week, and China GDP on Friday, and a whole bunch of Fed speakers also on Friday. So it's a week without so much macro data, but definitely still plenty of stuff going on. I won't spend too long on this, but we are coming into earnings season, and it's one where earnings have been revised lower as we come into it. But because they've been revised lower, it's a pretty low bar to beat. So analysts are expecting lower earnings versus where they were forecasting in July. So they've dropped their, they're still expecting earnings to go up, but by less than they were expecting back in mid-July. But on the other hand, the firms themselves are guiding something closer to a jump of 16. So, you'd always expect firms themselves to positively, but just the gap between analysts and firms is quite large. So maybe there's room for those analysts' expectations to be beaten. So the bar going into this earnings season is perhaps lower than it was going into the previous one. And